Hey traders, welcome back to another edition of the Market Preview. My name is Vasily, I'm your trading coach and professional Forex trader. For today's weekly edition, I prepared for you a very interesting discussion about harmonics, Fips, and price action. I prepared for you a very interesting example on a pound Swiss pair. There I will show you how do we apply these concepts all together to predict the market and then to trade the market. I think it will be very interesting and valuable for you, especially if you are interested in Fips and harmonics. So enjoy that video, don't forget to like it, don't forget to subscribe to my YouTube channel, and don't forget to leave a lovely comment because it motivates to record more videos for you. Let's start. Alright guys, so we are on the pound Swiss chart, and on the pound Swiss chart we're going to start the analysis with the daily time frame. And if you trade technical analysis and if you try to master technical analysis, remember that the best way to analyze the chart is to start from a daily. Daily time frame tells you a lot about the market, it tells you a lot about its current state, and it is very important for you to pay attention to that. So first of all, what do we see on a pound Swiss here? Here we see that the market is bearish. How do we know that it is bearish? What makes us think so? First of all, I want to focus your attention on this here. Here we have a new lower close. Here was our previous structure low, our previous daily close, right? Lower close. And now here, after this massive sell-off over here, we closed lower, yes. Moreover, pay attention to this high right here. Here, if we compare that high with the previous high, we have here the lower high, yes. And it is the indicator that right now pound Swiss is trading in a bearish trend. Yes, our rules for the bearish trend is met. And here on the pound Swiss we are bearish biased. For that reason we look for short trade right here and we look for the opportunities to sell the market. So where can we sell the market? Of course, the safest short trades are always from key levels, from key structure levels. So our task is to identify these levels on a daily chart. So what do we do right here? We look left at structure. We look left at structure and we look for the levels that were respected in the past, right? So I want to focus your attention on that level. Yes, you can see how many times in the past that level was respected. Yes, even here, many different times the market was respected that level. And here we a bit higher, we have another level. Yes, you can again look left at structure and you can see that this level was respected as well. So by that we have here a not very wide but quite wide area of supply. Yes, the area of resistance, and that area of resistance gives us a very nice spot to short the market. So if the market reaches that area, we will look for short opportunities, right? But what can be the problem right here? The problem can be with the exact entry to the trade, because if we just measure this area, you can see that we have this area is about 40 pips wide, right? So we need to know where exactly to short. Do we short just the lower boundary of that area, or we short the upper boundary of that area, or we short somewhere in between? So here harmonics will help us, and let me show you how we're going to apply that here. So to properly apply harmonics, we're going to analyze the price action on the lower time frame, on the 4-hour chart. So I switch to the 4-hour chart, and on 4-hour chart, what we are looking for? We are looking for the impulse legs. We are looking for the swings, right? So what do I mean by the swing? It is the strong directional movement, right? And here, after the market reached that structure low, we had a nice bounce to the upside, yes? So here we have our first swing. Then after that, the market retraced. It retraced and it set a higher low, a local higher low right here. So this is our second swing. And then right now you can see that the market is currently forming the third swing, right? So how we will apply that? Here we have a potential harmonic movement. How do we know that we have it right here? What we do, first of all, we take our first impulse, our first swing, and we just copy and paste that. We paste that from the level of the last high level, right? And we make the projection. So why this movement is called harmonic? It is called harmonic because here we have two things to consider. First of all, the length of the swing. Yes. So if we take the length of that swing, yes, it is 235 pips. And here we will expect that the market will go and reach the same length again, yes, respecting the rules of harmonics. Why should it respect the rules of harmonics? Because here, one more thing that you must consider is time horizon. So what do I mean by the time horizon? Here is when our bullish impulse has started, right? And here is the point where it stopped. So right here, if we take the curve, here is our time range of that impulse, right? Does it make sense to you? I hope it makes sense. So this is our time range. And I think if we draw the line right here like that, yes, just pay attention to that. Here, our impulse finished, yes. And here it started. So here is our time horizon. Now, if we analyze how the market trades during the second impulse, you can see that the time horizon here is almost equal. Yes, as you can see, it looks very, 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 very similar. And by that, we assume that once the market reaches the length of our first impulse, it may drop. Yes, it may drop as it did previously here. Yes, that is what harmonics mean. Yes, that it acts like it acted in the past, respecting the rules of harmonics, respecting the rules of the length, and respecting the rules of the time. Yes, so now let's take away all that stuff and pay attention to details here. What is more important for us here is that the market lying within the projection of our harmonic movement is lying perfectly within the supply zone that we identified on a daily. So our predictions on a daily were that once the market reaches that zone, it may respect that and drop from that. And then here we have the projection of our harmonic movement lying within the same zone, right? Lastly, what I want to show you right here, and the confirmation that we use right here are the Fibs. So we take here the Fib extension tool and we draw the extension from swing low to swing high of our harmonic movement, yes. And what you should notice right here is our projection matches perfectly with the 1272 extension. I have 1113 over here, but we don't need that. We just have the perfect match of structure, of harmonic movement, and Fibs, right? For that reason, here will be our level, yes, our level from where we will sell the market and from where we will expect a bearish reaction. Now let's discuss in details where the market will go next. Alright, so we have identified our reversal level, the level from where we expect the market to start reversing and to go down, right? And now we need to know where it will go exactly. And because the market here is harmonic, and we assume that it will continue being harmonic, here are some concepts that will help you to identify where the market will go. So first of all, what you should do right here, you should measure from where the market exactly started to grow right here. And what is very important is that we should look not for the wick but for the candle closes, yes, from where the candle closes, where was the lowest candle close right here, yes, and from where the market started to grow. And based on that, we need to measure what was the Fib retracement of that level from where the market started to grow. So we take once again our bullish impulse, and from swing low to swing high we draw the Fib retracement, right? And here we will try to get which level the market respected, yes? And you can see that here the market clearly respected the 618 level, yes? So why do we need that? Based on that, we will assume that once the market reaches our reversal point, it should reach at least this same 618 level, yes. So you can see I draw the Fib retracement again from our new projected bullish impulse leg, yes. So I draw it from swing low to swing high like that. And here we have the 618 again. So I assume that from that point the market will reach this 618 level, right? And then we don't know what's going to happen next, yes? We will try to catch a pullback from a key level following that strategy. Now let's discuss the trade management and where we will place stop here. So first of all, let's discuss where the stop should lie. And bit tricky with the stop here, because obviously our stop should lie strictly above our identified area of supply, yes, because something may happen here and the market can again form like a long wick, yes, and stop us out if we just place our stop above the 1 to 72 extension. So I want my stop to lie strictly above this entire area. So where should it be? I would say it would be somewhere here, yes. I think here we have just enough distance above our identified key level for the protection, yes. So 11935 I think will be just the perfect stop right here and will give us very nice protection. So our position here will look like that, yes. We sell from here, here is our stop, and here is our target. So we have very nice potential risk to reward for that trade. But here it's not so simple that we just short here and we let the market reach our target. We should start protecting our profits from a certain level, yes. When the market reaches some certain level, we set our stop to break even and make our trade risk-free. So it is very tricky where exactly we should start doing that. And here I want to focus your attention on that level over here. Why this level is important right here? Because first of all, it is the local structure high, yes, and moreover you can see how many times here it was respected, the structure shelf, yes, over here. So once the market reaches that level, I will set stop to break even and I will close half of my profits based on that level, yes, even a bit higher like that. I do that because some buyers will buy from that structure. For some buyers, it will be important structure support, and they will start buying from that. And we need protection. We need to start protecting our profits because everything can happen. This short position, it will be quite long. It can be like 1 week long, so we never know what's gonna happen during this entire week. So for that reason we start protection earlier, yes, based on the previous structure. And here is the place where we place our stop to break even to entry, right, and take half of profits. That is our rules here for the trade management. So as you can see here, just with the Fibs, with Harmonics, with structure and price action, we identified a very nice swing trade opportunity. Yes, we applied different concepts, we applied different methods here, and we found the consensus between them. Yes, we applied them all together to get where the entry is, where to set our stop, and where are our targets. So try to apply this approach by you and try to test that. Remember that for the perfect harmonic movement, we should need a match between the length of the impulses and the time horizon of these impulses. Yes, so these two conditions must be strictly met to treat the market like that. Sometimes we have just the equal lengths. It is not enough. For such kind of trading, we need the conditions like that. And by the way, remember one last thing that I wanted to tell you right here. The market may start coiling. The market may start coiling like that. And if it then reaches our entry, we won't trade that. We strictly need the respect of the time horizon. Yes, we want the time horizon to be respected. And if it's not, then we just cancel the trade and we don't trade at all. Yes, remember about that. So you don't, if the market starts calling, it doesn't mean that in 1 month, in 2 months, when the market reaches our entry level, you should trade. No. It is a local setup. Yes, we give that setup at least, just 1 trading day max to reach our level. And if it doesn't reach that, no, we don't trade. Remember, this is a very important rule of harmonics. Alright guys, that's it, and I truly believe that it was a very interesting discussion, and I hope that you will learn a way how to apply these concepts in your trading and in practice, right? So last thing that I wanted to tell you is that it is the last chance for you to join my premium educational group on a big discount. The offer expires this Sunday, and it is the best chance for you to learn my approach in details. I recorded many educational videos and examples on how do I execute the trades. I do the live streaming and I show my running trades and explain the entire logic behind the trades that I take. So if you want to see how I do that, if you want to see how the pro trader executes the trades, it is just the best opportunity to be in. So don't miss that. All the links are in the description below. Just contact me, Twitter, Facebook, Telegram, TradingView, anywhere, and I will show you what you will get. So thank you for watching, and I will see you next week.